The IRS is not someone you want on your bad side. In the US, if you're accused of a crime, you're innocent until proven guilty. With the IRS, it's the opposite.
You got to prove your numbers.
Charitable gifts, business expenses, real estate activity, the documentation is absolutely crucial, especially if you get audited. Do you have a CPA? Do you have a tax practice that's working with you that's going to be proactive, not reactive? What about crypto?
It's very scrutinized by the IRS right now. They're trying to find ways to get all that activity reported to them.
Let's talk specifically about how EWA as a firm helps. Let me give an example of why we tell executives your company stock should be less than 10% of your net worth. It's so important if you're an executive. Tax planning, diversification, balance sheet plan is so crucial. I think that's a good framework for how to audit proof your tax strategy. Over the past year, the IRS has reversed their layoffs for auditors, and they're starting to hire more and more. So we do expect that audits on individual and business tax returns are going to increase in coming years. Today, we want to help you audit proof your tax plan. We want to help you save as much in taxes, but also balance ensuring that you don't have a pain and a time suck of an audit coming over the next few years. So Nick, let's get right into it. So give us the background of, how many agents are they expecting to hire? And I know some of these were layoffs, they're coming back, but give us the lay of the land.
Yeah, so they, a couple years ago announced that they're going to be hiring 87,000 new agents, which I know caused a lot of panic to a lot of people, as it should. No one wants to go through an audit. No one wants to deal with that headache. They're trying to kind of strengthen their workforce and get more audits out there. It sounds like that seems to be the goal over the next, 5 to 10 years.
I looked up some statistics. So 266 million, a little bit over in 2024, tax returns are filed. That includes businesses. So out of that, 163 million in 2023 was individual returns. And so audit rates are, generally speaking, under 1%. But you put some statistics here, like under 500,000, about 0.3% of that category. 500 million increases to 0.5%. A million to 5 million increases to 1 to 1.6%, and then 5 to 10 it goes from 2 to 3, and then over 10 it's 9 to 11.
Right.
So some of the things that we've talked about previously, like QSBS, real estate professional status, these huge tax savings, we just really have to make sure that they're documented and legitimate.
Yep.
And if they're legitimate, it's an amazing strategy. You should do it. If you're really stretching, you have to consider, is it worth getting all that recaptured? Right, or if you're audited and they decide you don't qualify for these strategies.
And the headache. Audits can drag out months, over a year.
In the U.S., my understanding is, and correct me if I'm wrong, with the U.S., if you're accused of a crime, you're innocent until proven guilty. With the IRS, it's the opposite. You're guilty until you prove yourself.
You gotta prove your numbers, basically.
Yeah. Yep. The IRS is not someone you want on your bad side, bottom line. So, okay. Let's talk about some of the red flags that the IRS sees. I'm going to start to say low-hanging fruit. The IRS gets a transcript, right? The transcript shows every W-2, every 1099, every K1. Yep. Spend the time, get that transcript yourself. So what we do for our clients is we get a power of attorney signed and we're able to go and see that transcript. And so just as simple, if you forget to report a K1, and this happened to me, the tax firm that I hired to do my tax in the business no longer uses. Now we do it all in-house.
Yeah.
They prepare the business return. They prepare the K1s, my individual return. They just left my K1
off your individual return?
Yeah. So I actually didn't get audited, but the IRS is 2 years later, they're like, you owe this and interest and penalties.
Correct. Probably came down pretty hard on you.
Ooh. Yeah. It was really tough. So, and you had to pay it. There's no messing around. So
right.
I would say that would be number one is, do you have a CPA? Do you have a tax practice that's working with you that's going to be proactive, not reactive? And what I mean by that is reactive would be you get a letter in the mail about your tax return 3 years ago and say, where is this? Well, proactive is when you go to file the tax return. Here's what the IRS is expecting. Low-hanging fruit, give them actually because it's one thing. It's an automatic flag.
Right. Correct. Yeah. I've had clients in the past forget to give us something small like a 1099, not a huge amount of money shown on that 1099, but guess what? You still get that letter in the mail. You still get the letter saying, hey, we're going to adjust your return by this. The biggest one that I've seen is for gambling. So if you're a gambler, you're going to the casino, playing slots. If you win money, if you win a jackpot, you're getting a W2G. Even if you lose money throughout the year, you got to report that W2G. I've had so many clients have thousands and thousands of dollars W2Gs that they did not give to me because they just, in their mind, they're like, oh, well, I lost money throughout the year. I don't need to report this income. You need to report that income and offset it with your gambling loss deduction.
And the losses don't carry forward. So gambling is like the worst proposition. Yeah, it's active because like if you have a big year, there's normally like gambling, like most people, no matter what you say, I know it's professionals, net, you are down. Like probably 10, 20%. If you look at your total bets you place, you're probably down at least 10%. Like that if you're good, probably more if you're like.
Right, if you're just throwing in a little
chance like parlays, yeah. So you got to keep track of that. You know, if you won 100,000 on some lucky bet, and then you bet 200,000, so you're net down 100,000. If you don't have those records, you're paying income on 100,000.
Right.
When you lost 100,000.
Correct.
So it's like the worst proposition in the world. So keep the records on the gambling
for sure.
So documentation, obviously, charitable gifts, business expenses, real estate activity. The documentation is absolutely crucial.
Yeah,
especially if you get audited.
Yes. So I mean, again, just to further emphasize your point, make sure you have records, right? Especially if you donated $100,000 to charity, don't just throw out the little receipt. Keep that in your records, okay? Because $100,000 charitable contribution might be scrutinized. Okay, if they come asking and they say, hey, can you please verify, like confirm, give us proof that you did actually contribute this to charity? And you're like, I don't have that anymore. They're going to throw it out.
What about the algorithm of the IRS? Obviously, like if there's huge income fluctuations up or down.
Yeah.
So if you're in this higher income, like 1 to 2, 2 to 10, you're already at a high audit risk. But if there's some huge fluctuation where you went from 2 million of AGI to 1 million, because you left it a real, that's immediately going to be
right. That can be a red flag as well. So again, goes back to good record keeping. Again, we're not telling you don't try to decrease your taxable income in a legal way. Do it. You want to pay as less tax as possible, as legally possible. But make sure you're keeping good records in doing so. Because again, the last thing you want, and the IRS is a little delayed in getting to it. So by the time they get back to you, it might be 18 months later. Guess what? Penalty and interest just accrued on you for 18 months on top of the tax. Kind of like what you were saying in your example. So it's not something you want to deal with. You don't want to get that letter in the mail. It's not a fun letter to open.
What's the interest right now?
I believe it's 7%.
Yeah, so it's basically like what a mortgage rate would be. Yeah. The current market rate. So you
don't quote me on it, but
yeah, no, I believe that's right. But I want to say it was like a little bit over 1.5 per quarter. Yeah. If you do a Roth conversion, you don't pay in the third quarter. You don't pay it. It's like 1.5 or 1.7 that third quarter and the fourth quarter if you're waiting till, and the first quarter of the next year if you're waiting till April 15th to file the tax return.
Yeah.
So
it adds up.
Yeah. That's a big number. Okay, so Schedule C's that consistently show losses and is used to offset other income. The IRS is obviously going to look into that and say, what's going on?
Yeah. Is this a hobby? That's the biggest thing because hobby losses are not deductible. So if you have a Schedule C where maybe you're making $5,000 in gross a year, but taking $25,000 to $50,000 in deductions, netting that,
running your sports events through there that are not deductible anymore.
Exactly.
You can do meals, but not like entertainment.
Yep.
Right.
Yep.
They're going to see right through.
They're going to question that. They're going to be like, hey, you've shown a loss on this business for 7 years. What's the deal? And if you can verify it's legitimate business activity, they'll let you take the loss. But why are you losing $40,000 a year at that point?
No question. What about crypto?
So crypto is something that over the last few years has really been growing. It's very scrutinized by the IRS right now. So they're trying to find ways to get all that activity reported to them. So starting this year, tax year 2025, there is a new 1099 coming out. It's called a 1099 DA. Obviously, we'll see if it changes. There's still months to go. But crypto transactions will be reported to the IRS for the first time.
If they see something fishy with someone, they're probably going to go back.
Yes, correct. Right. It might open up the door for them to be like, oh, let's look into this guy in the past.
How far can they go back?
So they can go back as long as the return's been filed, the statute's 3 years.
Okay. But they're typically 3 years behind. So 2025, they're auditing 2022.
Right now, they're very behind.
Okay.
Yeah. So
gotcha.
And I also want, if you're substantially understated your income, that statute, I believe, stays open for 7 years.
Gotcha.
So if you failed to report $1 million gain from Bitcoin, they can probably take the stance that, hey, this is a substantial understatement. Yeah, the statute's going to stay open longer.
Gotcha.
I believe.
Well, let's talk some specifically about how EWA as a firm helps. I say this just educationally because these are all steps, regardless of whether you use a tax professional or this yourself, that you can take yourself, of having the tax and the wealth management, the financial planning already all married, is when you have a tax professional, you're scrambling in a separate firm. You're scrambling the information. You're one out of a couple hundred returns.
Yeah.
Because if you're with a financial planning firm, you've had countless conversations throughout the year. You know everything that's going on.
Right.
If you hold investments, most of the 1099s, investment income, even the W2s, we're going to have access to those right on the spot.
Right.
And we're going to know maybe some things that the clients don't even know that they have to report.
Yeah.
Or proactively go after that. And then the other thing too is caring for the tax returns and then also the power of attorneys. And what's the number? The 32?
The form number?
Yeah.
2848.
2848, where we can go in and say, hey, here's what the IRS is expecting this year. Here's what Fidelity said to you if you work at UPMC as a doctor. Right. Here's what they said to you at the W2. Here's the K1 you got from this private investment you did.
Right.
And we can make sure before you file
that at least all that is...
At least we're giving them everything expecting. If we don't, immediately you're the percentage of like they're going to look at you.
You're going to get a notice at some point. I do have an example of that. This is to show they are behind in this to kind of further that tacking on a penalty and interest. I had a client who forgot to give me a inherited 1099-R. It was $40,000 they took out. They did not inform me of that until the next year. And in that year, the IRS did not even contact them. But they're coming, right? They're going to eventually send you that letter. Yeah. But I'm just saying that's what I mean. So 12 months of penalty and interest just tacked on.
And so if they don't catch it 2 or 3, it's about...
Then
unfortunately, the IRS will say, hey, we're sorry, we're behind. We didn't catch this last year. We caught this 3 years later.
Right. They're going to...
So you have to pay interest for 3 years.
Correct. Yeah, because they're going to be like, oh, you failed to pay your tax. Here's, we'll say $10,000 in tax plus a couple grand in penalty and interest. Now you owe us 12 or 13 grand instead of 10.
Speaking from experience, 2020, and this is the year we started, EWA as a private RIA. So I was relying on the professionals. I checked over real quick and I was just like, there's no way this could have messed up because they prepared the business return, the K1 and the...
Right. It's all...
I think they were just overloaded. They shouldn't have taken as a client. Great prior firm, love them, but it was a big mistake. But I remember let's go fight it. Let's try to find the interest. Let's give them the story of how we just started business.
Yeah.
They do not care.
No.
At all.
No.
The IRS gave me zero break. I had to pay a full interest and penalty. But then the prior firm, they were like, it was a big penalty. So they're like, we can't afford this. I was like,
yeah.
So I was like, basically sue us or insurance will cover it. I'm not going to sue you.
Yeah, right.
So then I think they covered a little bit of it and then I had to pay it. So I just speak from experience, and that was, I think, caught 2 years later.
If you wanted to fight the interest at that point.
Well, I went back and forth 3 or 4 times. So it was, I probably spent 30 hours
on it
to get
right
nothing.
Yeah. And that's something to consider too. If, some of these notices might be pretty minimal, right? With a little bit of interest, a little bit of penalty tacked on. Keep in mind the time it's going to take. If you want to fight the IRS, it might take you 12 months, 18 months.
It may take you a month to get a response.
To get a few $100.
The response you get is like, hey, we got your response.
But give out another 90 days.
Exactly.
Correct. Yeah.
It's crazy.
So is it worth your time at that point? And that's kind of a feather in the IRS's cap where you might just be like, screw it. I would rather just pay it.
Yeah. There's lots of ping pong games you can play.
Yeah.
I think the best ones to play if you can get tasks done quickly. IRS, you're playing a ping pong day of months.
Yes.
Here's balls in your court. A couple months later, then you have to go, what were we talking about again? To open up all your files and then, yeah. So the goal is stay out of the ping pong game with IRS.
Correct.
If you get audited, you're going to audit and have the records, boom, let's go.
Yeah.
Hopefully it's a quick in and out, but missing payments, missing documentation, having the surprise, because it's as a business owner, whether it's 10 grand, 20 grand, 100 grand, whatever it is,
you're
not expecting that 2 years later. That's a huge surprise.
Yeah, it hurts a little bit.
You may have an emergency fund, but it sucks.
Yeah, for sure.
Yeah,
for sure. And there's no way to fully proof the IRS from asking for further information, right? So I actually, in my old firm, we had a client who had some loss from Hurricane Ian, back in 2022.
Yeah.
We claimed a loss that was actually substantially under what they recognized, and that was what they wanted to do because they didn't want to go through all the hoops of getting it,
all the values,
all that stuff. Yeah, they're like
the easy snip test. If they come in and say, "Oh, they could have
done a lot more than that," right? They just recently got a notice requesting verification and proof of the value of the loss we claimed. We provided what we had, which was kind of like a little Excel spreadsheet. That was declined, so they actually had to go back and hire an estimator to value the loss. Guess what? The loss they were allowed to take was twice as big.
And so now the IRS getting audited is going to have to owe them money.
Correct. But now this is going, it's been, I think, close to 12 months now.
Now, IRS pays them interest, right?
They say they should automatically adjust their tax return to reflect that.
Okay.
And then they should give them a refund with interest. But now we just submitted that documentation a couple weeks before I had left that firm. We're basically at 12 months as it is. They probably won't hear back from them for another 3 to 4 months, if not longer. So now you're
That's just such an unnecessary thing to have in your headspace for 3 to 4 months.
right.
But the IRS, it doesn't matter if it's $1 or $100, it's all stressful.
Yeah, and we're not talking pennies here because, several $100,000 of deduction.
Yeah.
It's not just, a couple of dollars here and there. It's substantial tax savings.
Yeah. So I think that's a good strategy is like if you get audited, like be ready to get more money back. Cause like, okay, I'm going to now show you the proof. And now it was $100,000, not $50,000 reduction.
Right.
I just didn't want to get audited.
Exactly. They don't want to raise that red flag. They didn't want to jump through the hoops of getting an estimator because at that time, everyone was getting an estimator. Right.
Yep.
So they're like, this is more than fair. This is a lot less than that we actually lost. Let's just go with this. And they still got questioned. And now they're going to get even more money saved.
I wonder if they got questioned because they underdid it so much.
I think the hurricane losses are getting questioned. We had a couple other clients get scrutinized for that.
So just as a heads up, if you think your returns are pretty simplified, like your high income W-2, we see a lot of surprises, and we're even like a physician that's coming out, residency making like 70 grand, and now they're like making $500,000. Let's say a orthopedic surgeon. The second year, they're getting like RVU bonuses. And so, or this could be an executive as well. I'll go through 2 examples. So like that physician, now let's say that physician does a little bit of like medical malpractice opinion, like so some 1099 income.
Yeah.
So let's say, they're 500,000, they're withholding the right amount. You need to double check that, by the way, because it's up to elections that matter a lot if you're married, if you have kids, all that stuff.
Yeah.
So a lot of HR softwares, they'll withhold like 24% of the bonus. And so if you're making $500,000, most likely, if you're single or married, you're going to be at a 32, 35, 37% tax bracket, depending on how high your income is. And so if they're withholding 24 and you're at 35, that's an 11% difference. So if that's a $100,000 bonus, that's 11 grand automatically. That was paid in February and you didn't know that, you're going to owe 11 grand plus the interest on that 11 grand. So now it's selling almost 12 grand.
Right.
And you're filing your return in April and you're like really pissed off. Because like,
yeah,
I thought I paid my taxes through and then let's say you have 15 grand from the medical malpractice 1099 where you're paying, that gets tacked on to all your other income. So that's a 37 plus 3% state plus double Medicare, double.
Right.
So almost half of that's gone. You didn't pay it. So add that 7,500 plus the interest on that. So now it's like a $20,000 surprise. We see this all the time.
Yes.
And so then the other thing too is we've seen this with other CPA firms, and then the other CPA firm will just go like automatically into their like nerdy books and say safe harbor, and they'll give the client homework to write a check for $5 grand every quarter.
Yeah.
So now they're writing a check, like manually writing a check to the federal, to the state, and to local.
Yep.
For like $5 or $6 grand a quarter.
Right.
Giving the client homework. What orthopedic surgeons remember to do that?
Exactly.
So I think this is where the financial planning and the tax come together, is we're going to know, is that next year, is that stuff relevant? Like, how's your production look this year?
Right.
Is it going to be higher? Let's predict that. Let's go into your paycheck on a monthly basis. Because money's a temperature. Like 20 grand is a surprise for anybody.
Right.
And that can disrupt, a financial plan regardless of your income. Let's go in your tax software and let's take a little bit per pay. They're paid 24 times. Let's take 1,000 per pay, so 24,000. It's going to be a little bit of a hit, but they're not going to notice that a ton.
Right.
And then
come March, come April,
they're square.
Surprise.
They're all square. Or you do that in like, if you're making 500,000, let's say, because Social Security gets capped out at like 168, I think.
Yep.
So the first 3-4 months, you're going to be lower because 6.2% is coming out for your Social Security. So maybe then after that's done, so if you're 500, maybe your paychecks are like 21 a month, and then they jump up to like 24 a month.
Right.
Let's do let's take the 21 a month, and then in April, let's add an extra federal withholding for like 1,500 a month for the rest of the year.
Yeah.
And then your cash flow is pretty smooth.
That's the same. Yeah.
Through the whole year. So these are all strategies we can consider, because budgeting, a lot of people don't understand, why is my income go down in January and then back up in April? And it's hard from a budgeting perspective. They can throw everything off.
Yeah. I can't say it enough. Talk to your CPA throughout the year. Talk to your financial advisor throughout the year. Because I don't care how much money you make, you don't want that big surprise in April.
No.
And if you're a high earning W-2, like you were saying earlier, it's almost impossible for them to withhold enough wages.
Yeah.
It's on your wages. You have to usually do a manual adjustment on your W-4. And when you start that job, you probably don't know what's going on. You probably just fill it out as verifying joint and that's that, or fill it out as single and that's that.
Yeah.
But most of the time, when you get to that level of income, you have to fill in that additional withholding line item.
So here's the one. I'm going to give an example of why we tell executives, like your restricted stock units, like your company stock should be less than 10% of your net worth. And usually it's like 60 or 70%. Because like, let's say an executive is making like a $300,000 or $500,000 base. They get a cash bonus of $500,000 and they get $500,000 of RSUs. So there's like a top C-suite executive, $1.5 of total comp. The RSUs they get granted in year 1, they don't vest till year 3. So there's no taxes in year 1 or year 2.
Right.
Year 3, they get taxed on whatever the stock price is worth. So let's say that $500,000 is now worth $1 million. They have to pay $1 million. So most companies allow them to withhold like a minimum 24% of that.
Right.
Well, if someone's making $1.5 million, clearly that's in the 37% tax bracket.
Yeah.
At 24, we're at a 13% delta. So a 13% delta, now that stock's worth $1 million, that's $130,000 of tax.
Right.
This happens all the time, by the way.
Right.
So now, how the heck are we going to pay $130,000? And so now they have company policies. Well, we're in a blackout period. We can't sell more stock to get it.
Right.
Because we've inside information. And it looks bad, right? Because it shows I'm not. Now, a couple years later, this is a true life story, by the way.
No, for sure.
Now the stock that was worth, it was $25 a share, was $50 a share. They had to pay tax on the 50. A couple years later, they can sell it. Now it's worth 25.
Yeah.
So they just paid tax
on that
and didn't see any of it.
Right.
And now if they wanted the money, they're like, oh, I can't sell it now because it's down as they come back.
Right.
It's so important if you're an executive. Tax planning, diversification, balance sheet plan is so crucial if you're an executive. I cannot stress that enough. And you think, oh, I make $1 million. I've met so many people make $1 million that feel absolutely broke. Now, they have assets, which is great. But from a cash flow perspective, because of how those RSUs get taxed and they only with all the 24,
exactly. You don't want to be scrambling in March and April to find $130,000 in your example. You just don't want to be no one wants to be in that position. I don't care how much money you really make.
No question.
Well,
these are just some sample of, I think, the proactive nature of don't start tax planning scrambling in January, February.
Yeah.
It should be, the tax plan should be 99% done before the end of the year. Because a lot of strategies require their 12/31 deadline. Some retirement contributions, other things you can do up until the tax filing deadline. After like April 15th of 2026, you can do for 2015. But a lot of the big stuff you have to do calendar year basis.
Right.
So 99% of your tax plan should be done before December 31st. And when you're not scrambling.
Yeah, in those 2 or 3 months.
Yeah.
Again, I'm a CPA. I don't know if I should say this or not. If you try to reach out to a CPA in March, February to talk tax planning at that point,
it's a little too late.
It's a little too late. Yeah. They might not be super responsive. They might try their best to help you, but it's almost too late to do anything. You know what I mean? The numbers are the numbers at that point. So whether you have a CPA that gets back to you right away or not, the numbers are the numbers.
Okay, unless you work with EWA, we're getting tired. I was talking to everybody, and then it was a little stressful. But now we have a couple more CPAs that were grown.
Exactly.
So yeah, any closing thoughts? I think that's a good framework for how to audit-proof your tax strategy.
Not a broken record here. Record keeping's huge for anything you want to do, any sort of aggressive nature. Even if you don't think it's an aggressive nature, keep your records.
No question.
Talk to your CPAs. Okay, don't just drop surprises on them in March when you drop off your tax file or send in your tax file. Try to keep that open line of communication throughout the year. That way they can, because you might be thinking you're doing something great, and they're like, no, you should be doing this instead.
No.
Right? And that might save you thousands of dollars. Or in the W-2 example, the high earning W-2s. If you don't talk to them until November, December, they can't fix your W-4.
Right.
Because at that point, it's too late.
Yeah, the taxes have already been withheld.
Right. So, but if you reach out to them in June, July, August, there's at least some time for that change to kick in and help. Right? Well, you still have to find some cash. But again, for 2020, the next year, so in this scenario, 2026, you're good to go.
No question. Well, Nick, appreciate your expertise. Thanks for joining. Everybody look forward to catching you next week.
Thank you.